Think about this. How do businesses never lose track of money? They're constantly buying things, selling things, taking loans, paying expenses. So with all of that happening at the same time, how does everything still stay organized and accurate? There's actually one simple rule that keeps everything under control. That rule is called the accounting equation. This is the accounting equation, the foundation of accounting. Every single transaction in a business must follow this rule. If this equation doesn't balance, something is wrong. But to really understand it, we need to quickly remind ourselves of what each part means. So let's do a very quick recap. From the previous videos, assets are what the business owns, liabilities are what it owes, and equity is what's left for the owner. We're not going deep into this again. What matters now is how these three connect, because this connection is where most people get confused. Here's the key idea. Every asset a business has comes from somewhere. Let me pull up the accounting equation again. So everything you own, it's either funded by borrowing money, that's liabilities, or by the owner putting money into the business, that's equity. Nothing just appears out of nowhere. To really understand this, let's visualize it in a simple way. Think of this like a balance scale. On one side, you have everything the business owns. On the other side, you have where that money came from, liabilities and equity. And no matter what happens, both sides must always stay equal. Now let's see how this works with real examples. Let's say the owner invests $5,000 cash into the business. Now the business has $5,000 in cash, which is an asset. At the same time, this money came from the owner, so equity increases by $5,000. So on one side, assets increase, and on the other side, equity increases by the same amount. That's why the equation stays balanced. Now let's look at what happens when the money doesn't come from the owner. This time, the business borrows $3,000 from the bank. This increases $3,000 in cash, which is an asset. But in this case, the source is not the owner. It's a loan, which means liabilities increase by $3,000. So again, assets increase and liabilities increase by the same amount, keeping everything balanced. But not every transaction increases both sides. Now, the business buys equipment for $5,000 using cash. So cash decreases by $5,000, and equipment increases by $5,000. Both cash and equipment are assets, so one goes down and the other goes up. This means total assets stay the same, and nothing changes on the liabilities or equity side, so the equation is still balanced. If you understand these examples, you already understand the accounting equation and how it works. This equation isn't just theory, it's used in everything that comes next. When we start creating journal entries, preparing T accounts, trial balances, and financial statements, all of it is based on this structure. So if this makes sense now, the rest of accounting becomes much easier. Let's quickly recap everything. To summarize, this is the accounting equation. What it means is that everything a business owns is funded by either borrowing money or the owner's investment. And no matter what happens, this equation must always stay balanced. Let's try to test your understanding with a slightly different scenario. The owner withdraws $1,000 cash from the business for personal use. Now think carefully. Cash is leaving the business, but what else is affected? And which part of the accounting equation changes? Drop your answer in the comments.